Hello everyone, I'm Yash, and in this presentation, I'll be walking you through my three statement financial forecasting and scenario analysis project for Arvanta India Manufacturing Private Limited. Arvanta India is a fictional manufacturing company created for the financial modeling case study. Now, this model has been developed in Microsoft Excel and covers a 3-year forecast period starting from financial year 2026 to 2027 and continuing through 2028 and 2029. So the purpose of this project was not simply to forecast a few financial numbers. The objective was to create a fully connected model where revenue, profitability, cash flow, capital expenditure, depth, and the balance sheets all work together. Now, before I open the Excel workbook and explain the calculations, let me first provide some context about the company, the business challenge, and the overall structure of the model. Moving on about Arvanta India. Arvanta India Manufacturing Private Limited is a fictional mid-sized Indian manufacturing company that produces and supplies both industrial and consumer components. Like most manufacturing businesses, the company operates across several interconnected areas. It needs raw materials to maintain production, inventory to meet customer demand, plant and machinery support to support manufacturing capacity, working capital to manage daily operations, and a reliable distribution network to deliver products on time. Now, each of these areas has a direct financial impact. For example, purchasing more raw materials affects inventory and supplier payments. Investing in machinery affects cash flow, fixed assets, and depreciation. Similarly, higher sales may improve profitability, but they can also increase working capital requirements. Therefore, as the company plans for future growth, management needs more than a simple revenue forecast. It needs a structured financial model that can evaluate profitability, liquidity, investment requirements, and long term financial sustainability together. Moving on to the business challenge. The main business challenge was that Arvanta India did not have an integrated financial forecasting system. Different financial estimates were being prepared separately. Revenue growth was forecasted independently without being properly connected to cost and profitability. Capital expenditure and debt repayment schedules were also maintained separately. Cash generation and future balance sheet position were not being modeled dynamically. The problem with this approach is that no financial decision operates in isolation. For example, suppose management changes the expected revenue growth rate. That change should automatically affect production cost, profitability, receivables, inventory, cash flow, retained earnings, and ultimately choosing the balance sheet. But in a disconnected system, management would need to update all these calculations manually. This increases the risk of errors and makes it difficult to understand the complete financial impact of business decision. So the real requirement was to build one integrated model where a change in any major assumptions automatically flows through entire financial forecast. Now moving on to the objective of this project. Based on the challenge, the objective was to develop a dynamic, integrated, 3-year financial forecasting model that could act as a single source of truth for management. The project had four objectives. So the first objective was to forecast revenue and profitability. This included projecting the complete profit and loss statement, starting from revenue and moving to gross profit, EBITDA, profit before tax, and profit after tax. The second objective was to project future cash flows. So the model needed to show how much cash the company would generate from operations, how much would be used for capital expenditure, and how much would be affected by financial decisions such as debt repayment and dividends. The third objective was to estimate the future balance sheet position. This meant forecasting assets, liabilities, and equity while ensuring that the accounting equation remained balanced. The fourth objective was to compare different business scenarios and monitor key financial indicators. So the management should be able to evaluate best, base, and worst case outcomes and understand how different assumptions affect the company's financial health. So together, these objectives convert the model from a basic forecasting file into a practical management decision support tool. Moving on to key business questions the model was designed to answer. So before building this workbook, I first identified the key business questions that the model needed to answer. This was important because the financial model should not be created around only formulas, right? It should be created around management decisions. The first question was related to revenue and profitability. So, what could the company's revenue and profit after tax look like over the next 3 years under different growth scenarios? Second question was related to capital expenditure. Would the cash generated from operations be sufficient to support the company's planned investment in plant and machinery without creating liquidity pressure? The third question focused on debts and dividends. Could the company repay its outstanding debt obligations while continuing to distribute dividends to shareholders? The fourth question addressed sensitivity and risk. So, how would changes in revenue growth and raw material cost affect profit after tax and company's overall financial position? And finally, the model needed to answer two basic but critical questions. What would the closing cash balance be at the end of each year? And would the projected balance sheet continue to remain balanced? Now, you see, every sheet and calculation in the workbook was designed to answer one or more of these business questions. Moving on to integrated financial forecasting model. So, to solve the problem, I developed a fully integrated three statement financial model in Microsoft Excel. The model follows a clear financial flow. It begins with the assumptions. These assumptions then drive the profit and loss statement. The profit and loss statement feeds into the cash flow statement, and the cash flow statement, along with the supporting schedules, updates the projected balance sheet. So all major assumptions are managed from one centralized section. These include revenue growth, cost of goods sold, capital expenditure, depreciation, debt repayment, tax rate, dividend payout, and working capital. For example, if the revenue growth assumption is changed, the model automatically updates revenue, cost, profit, receivables, inventory, cash flow, retained earnings, and balance sheets similarly. Similarly, if like capital expenditure is increased, it affects inventing cash flow, property, plant, and equipment, depreciation, profitability, and closing cash. So this integration is most important feature of the workbook. It ensures that the P&L, cash flow statement, and the balance sheets are not operating as three separate reports. They are functioning as one connected financial system. So what the Excel model includes. As you can see, the first section contains assumptions and scenario framework. This acts as the main control center of the model. It contains the key financial assumptions and allows the user to switch between best, base, and worst case scenarios. The second section is a 3-year profit and loss forecast. This projects the company's performance from revenue down to profit after tax. The third section is the cash flow section. So it captures cash generated from operating activities, cash used in investing activities, and cash movements from financing activities. The fourth section is the projected balance sheet. So it forecasts assets, liabilities, and equities for each of the 3 years. It also contains an automated tie check to confirm whether total assets are equal to total liabilities and equity. The workbook also includes a detailed caption expenditure and depreciation schedule. This schedule ensures that new capital expenditure is added to fixed assets and that the related depreciation is reflected in both the P&L and balance sheet. Finally, the model includes sensitivity analysis and an exclusive dashboard. These areas help management quickly understand key trends, compare financial outcomes, and identify potential risk areas. So, moving on to scenario framework. So, one of the core features of the model is the scenario framework. Rather than relying on one fixed forecast, the model allows management to evaluate three possible operating environments. The first is the best case scenario. This assumes a stronger revenue growth, lower rank material cost, and improving working capital efficiency. It represents an optimistic outcome, but the assumptions are still intended to remain realistic. The second is the base case scenario. This represents management most likely expectations based on current trends. It uses moderate revenue growth and relatively stable costs and working capital assumptions. So the base case therefore acts as a primary planning scenarios. The third is the worst case scenario. This assumes slower revenue growth, higher cost of goods sold, and great pressure on liquidity. So it is mainly used to test whether the company can remain financially stable under difficult operating conditions. An important point is that underlying formulas remain the same across all the three scenarios. Only assumptions change. This creates a fair and consistent comparison because the financial logic does not change from one scenario to another. So now that the business context, project objective, and model architecture are clear, I'll move into the Excel workbook and explain how the model works in practice. So I'll follow the same logical sequence used to build the model. We'll begin with assumptions sheet because this is where the forecast is controlled. After that, we'll move on to profit and loss projection to understand how revenue and profitability have been forecast. We'll then review the cash flow statement and see how profit is converted into actual cash movement. Next, we'll look at the projected balance sheet and automated tie check. Finally, we'll review the sensitivity analysis and executive dashboard to understand the main financial outcomes, risk, and management insights. So let's now open the Excel workbook and begin with the assumption sheet. Okay, so we'll move on in the next video.